Hi, Simon Singer again with the Tax Planning Institute. Today, what we're going to talk about is something that we call cash flow modeling. It's really a subset of a piece of software that we buy from a firm called InsMark. And at the end of this, we'll share with you a really incredible deal that we've been able to create for our members with InsMark. But this particular system is called Wealthy and Wise. It is absolutely the best piece of software on the marketplace. I'm not trying to sell you on them. I'm just telling you that's what we use. You're free to do whatever you want. But cash flow modeling is really kind of interesting because whether it be for retirement purposes, whether it be from estate planning purposes, asset protection purposes, people are basically afraid to do planning because they're afraid they're going to run out of money. And what the original genesis was of this software was to prove to people that A, you have enough money to maintain your lifestyle, by whatever criteria you want to make, or you don't. And if you don't, the software will illustrate when you run out of spendable assets. And simultaneously, it will also sit there and tell them whether they have enough money to be able to gift to their children while they're alive, or to an heirs trust or something of that nature after they pass away, a means of reducing estate taxes, paying for estate taxes on a discounted basis, possibly being able to buy life insurance to pay those estate transfer costs. And the bottom line is it just allows us to play an incredible amount of what-if games. Now, that's the first part that was interesting. But then what we discovered was there were algorithms in the software that would actually solve to see which asset they should access at what time and what amounts based on what the tax treatment was, what the yield was, what their lifestyle requirement was, in order to create a more efficient structure. Well, by creating a more efficient structure, you have choices. You could spend more money while you're alive. You could give more money away while you were alive. You could pass more money on to your children. You could give money to charity while you were alive or after you passed away. It created a whole bunch of different alternatives that we never realized. And so while the original purpose of this software was designed to convince people they have enough money to live on and convince them that they have enough money to give money away, hopefully to buy life insurance, because that's what the original genesis was, the potential here for fee-based consulting is monumental. And fee-based consulting is what most people think they want. And so it's a way to be able to get your foot in the door, do some interesting modeling for them, help them be able to accumulate more net worth without changing any of their investments, without changing their tax brackets, without changing the yields, just literally how to be more intelligent as to how they access assets. So we call it cash flow modeling, and I want to share with you a few things that we've done. So we call this efficient versus non-efficient, meaning non-efficient, you just arbitrarily go wrap your arms around your assets when you're age 65 and start distributing proportionately for the rest of your life. That's what I was taught when I first entered the business in the late 60s, and that's what most people are taught, but it isn't necessarily correct. In fact, it's almost never correct. So this is a typical IRS Section 230 disclosure. We're not giving any financial advice at this point, so we don't need to spend any time on it. But what I've done here is I've created a little summary as to what happens with these people. Their ages 60 and 65 years old. Their life expectancy is 93 and 88. They want $200,000 a year net after taxes, indexed for inflation at 3%. They have a current net worth of $6.4 million. Their tax brackets, the yields on the investments, the turnover rates on the investments are all unchanged in each scenario. And we're going to have 4 or 5 scenarios. We're not going to go through all of them today, but I want to show you the results. If they keep doing what they're doing, spending the $200,000 net after taxes, at life expectancy, their total estate assets are going to amount to $12 million. There's going to be $616,000 worth of transfer taxes. That's a combination of income in respect of a decedent on their qualified plan money and whatever estate tax there might be. So the heirs are going to wind up with $11,600,000. No money goes to charity, and their cumulative net after tax income would have been $8,530,000. That's our baseline. Well, what happens if we want to efficiently access the assets, draw the same $200,000 a year index for inflation, allow the investments to be identical, make no changes in tax brackets, no changes in yields, no changes in turnover rate, nothing changes. All they do is they access them more efficiently. Well, instead of the estate growing to $12 million, it grows to almost $19 million. But likewise, since there's been no planning, there's a proportionate increase in estate taxes. It's $4 million in estate taxes as opposed to $616,000. But the net to the heirs is $3 million more, $11 million versus $14 million, and the cumulative net income is identical. All we did is take a more intelligent approach to which assets, when, and in what amounts. Kind of interesting, and as you can see, the potential there is staggering. All right, well, what if we wanted to, instead of accumulating more money for our children, what if we wanted to increase our income, but not really do too much of a negative to our children? Well, if we wanted to increase our income, which, by the way, over on this side here, it's now increased by $2 million over that 25 years, from $8.5 million to $10.5 million. The estate values still went up. Instead of $12.2 million, they're now $13.5 million. The estate taxes dropped to $2.3 million. The heirs still inherit $11,200,000, $400,000 less than if they didn't make any changes. But mom and dad got $2 million more of cash flow. I think that's really exciting. Let me go down another layer. What if I did the efficient saving for heirs and generating additional cash flow for mom and dad, and use some of my excess cash flow to buy, a few $1 million worth of life insurance outside the estate? Well, the estate would have still grown to $13.5 million, not $18 million, but more than the $12 million originally. The estate taxes are going up to $2.9 million, more than the $616,000. But the heirs, because of intelligently using the life insurance as an asset class, inherited $18 million versus inheriting $11 million. And mom and dad still got $10 million more in cumulative net income. By the way, notice nothing went to charity. But what happens if we wanted to include charity? Efficient gift plus life insurance plus a gift to charity. The estate grows to $15 million because there's some tax benefits when you give monies to charity. The estate taxes drop to $6,700,000. The net to heirs jumped to $15 million, $4.4 million to charity, and almost $10 million of cumulative net income to mom and dad. I think the summary, if you believe it, and I'm going to document some of it for you in a minute, if you believe the summary, you'll find that the opportunities there created by this piece of software and our mindset are really pretty exciting. So now what I'd like to do is I'd like to go into the current plan, and I'm not even going to bother to show you all of the analysis and all the studies. There's actually 26 pages to this analysis, but I want to give you a general feel for it. Here is the net worth of the individual: $600,000 in taxable interest assets, $800,000 in tax-exempt interest, $2.25 million in equity assets, a total of $1,650,000 in qualified plan money, $750,000 for Matthew and $900,000 for his wife, a total liquid assets of $5,300,000. If I add to it illiquid assets, would include their principal residence and a vacation home, as well as their personal property, that is another $1,500,000. So the total estate assets at the beginning are $6,833,000. The retirement plan assets, we're going to take minimum distribution unless they needed more. And the cash flow funding, in other words, where is our sequential asset for cash flow coming from? We used spouse's retirement plan assets, then his retirement plan assets, then mutual funds, then his second series of mutual fund, then tax-exempt bonds, and then the CD, just to give you a bad example of what people might tend to do. The income tax rate stayed at a level 35%. By the way, just so you know, this software doesn't calculate income taxes like tax return software might. This is a flat 35% on everything he takes out. So he'd have to be making an awful lot of money for 35% level across the board, unless he lived in a state with a high income tax rate like California does. Their life expectancy jointly is 29 years, him at age 93, her at age 88, and that's where we ran our analysis to. The CD we had growing at 4%, the tax-exempt bonds growing at 3.5%, so you can tell this was done a few years back. The mutual funds are growing at 7% plus a 1% dividend rate, and we're assuming the qualified plans are earning 8% each. You can change any of these assumptions that you would like. We typically want to get them from the client because it's their analysis that we're doing. So this is the initial page. So this is a page that shows what his annual cash flow required is, $200,000 net after taxes, spendable money, and then we index that by 3% every year. And in this situation, we flattened it out when he was 84 years old. just because we assumed that from a purchasing power perspective, he was going to be spending less money as he got older. His expected after-tax cash flow, and I'll show you where that comes from in a minute, starts at 120, and it changes each and every year based on where it's coming from, what the tax treatment is, what the asset value is. Likewise, the total after-tax cash flow from the retirement plans. I'll show you this in detail in a few minutes. And if I go over to this column over here, column 6, if column 6 equals column 1, then I know and they know that they've got enough money to maintain their lifestyle based on the assumptions we used. So they needed a total to age 100 of $10.9 million. They have $10.9 million. But if we look real carefully, $5,651,000 came out of their equity assets. $1,793,000 net after taxes came out of their retirement plan assets. So there's Social Security built in, all kind of things that we're able to build in. So let me show you a little bit of the detail. Assuming this, they started with $6.4 million. The next one I go to is the wealth transfer summary after providing the cash flow required for them to maintain their lifestyle. $6,800,000 at the beginning. These are year-end numbers. And I want you to see that life expectancy, it grows to $12.2 million. And we have our $11,600,000 as to what the year-end transferred amount is to the heirs. And then the rest of the pages are basically going to give us some detail. The total liquid assets, $5 million, illiquid, $1 million, total estate assets, $6 million. It shows us what the exemption amounts are, and then it shows us when and if there's any estate taxes due. But notice there were still income taxes here because there were income tax on the qualified plan assets. But when we ran out of qualified plan assets, we didn't have to pay any income tax there anymore. So if we come over here, we show there was $616,000 of taxes in total, a combination of estate tax and income tax. If I drop that down to a summary of retirement plan assets, it shows that I have $121,000 of pre-tax withdrawal out of the $1,650,000. And so my assets inside my retirement plan actually increased by a bit. But I want you to remember this $121,000, that's the gross number. The after-tax number is $79,000. If I go back a couple of screens, you'll see here's the after-tax cash flow in this column right here of $79,000. So all of the follow-up sheets reconcile all the numbers on these pages here. So let me go back to where I was. Here's the $79,000. Now I come and I look at the details of the defined contributions on Matthew's plan, and it shows that we didn't pull any money out of there for the first 5 years, and then we pulled out $40,000 pre-tax, $26,000 after-tax, and little by little we bled down the account. Same thing on Catherine Fox's numbers, except there we didn't take any money out of it at all, and the assets we did take money out of there. We took $121,000 out. That's where the $79,000 came from. And then eventually we run out of money down here at the end of the 8th year. Here's a summary of liquid assets. Here's my retirement plan assets, the value of my taxable assets, my tax exempt assets, my equity assets totaling $5,254,000. And if we wanted to bother, I could go back and reconcile those for you on the summary pages. So all these is just a detail of what the summary showed originally, but it's important to know where you put these pages because a client is going to want to see some reconciliation and some justification, not just your summaries. This is the detail of the taxable CD account. If you'll notice, we never took any money out of there. We could have created whatever order we wanted to. Likewise, the tax exempted, we didn't take any money out of there. Summary of equity assets. Here's the sale of assets. Here's the capital growth. Here's the after-tax dividends that are reinvested or accumulated. Here's the year-end values. And here's when we started to take money out of there. And those numbers will show up on that cash flow page at the beginning. Here's the detail of the second equity account. And then here's the summary of illiquid assets. The reason that's important is a net worth gets estate taxed, but you can't live on net worth. You have to live on liquid assets. So it shows his principal residence, his personal property, and his vacation home totaling $1,005,000. And by the time he reaches life expectancy, that's grown to $6,300,000 using 6% growth on his principal residence, 6% growth on his vacation home, and a negative 5% diminishment in value on his personal property. If any of you have ever tried to sell a used couch, you'll know what I'm talking about. Here's a summary of the transfer taxation of the defined contribution plans. This is important because remember initially there was no estate tax? Well, here we're talking about 35% of the value of his qualified plan, $1,650,000. $577,000 was going in income tax. Income in respect to the decedent, 35%. When you get people worth more than $10.5 million, this number jumps to about 70 or 75% combination of estate tax and income tax. Here's more details of the transfer taxation on the defined contribution plans. And I skipped literally half of the pages of reconciliation. So I didn't want to bother you at this time. This is not designed to teach you how to use the software. It's just designed to show you the value of utilizing it. Now, here was the software about an efficient way to be able to access the assets. Exact same criteria, exact same assets, exact same income requirement, exact same ages, exact same tax treatment, exact same turnover rate. Nothing changed whatsoever except which asset do we access at what time. So you'll notice I still need $200,000. I still need $350,000 when he's 85 years old. Nothing changed. Expected after-tax cash flow didn't change. That was Social Security and money drawn from various investments. Likewise, nothing changed here. The wealth transfer summary, however, now went to $18 million because I used a more intelligent approach of how to access it. There was $4 million in transfer taxes, and the heirs inherited $14 million as opposed to $11 million. Pretty interesting. If I go to the efficient version and I desire increased income, then all of a sudden I want you to notice that I flattened out at $409,000 as opposed to $350,000. And all that does is generate $13 million through age 100 as opposed to, I think it was $8 million at age 100. And then here's the wealth transfer summary after providing the increased cash flow. It actually increased by a bit. The taxes increased. They got $11 million net to the heirs as opposed to $11 million net to the heirs, but mom and dad wound up with $2 million of additional cash flow. Now, to be honest with you, that's pretty much all that we need to go through today. I could have gone through each and every one of the scenarios, but I kind of felt like 1 through 1, 2, and 3 might be very interesting for you to see. And we're going to go into more detail on this at a later point in time. But in the meantime, I think this is enough for today, and I thank you for listening. Thank you.